Okay, good morning, ladies and gentlemen, and thank you for joining our latest series of webinars with Eve Siegel of Siegel Asset Management Partners. My name is Paul Duran. On behalf of the entire team at ELCO Management, I would like to introduce Eve, our sub-advisor for the income infrastructure and energy transition portfolios. I would like to remind everyone that today's call is being recorded and that a replay will be available. If any questions should arise, please use the Q&A tab at the bottom of the screen. Now I'm just sharing some important disclosures.
There we
They're on
go.
your screen now. And with that, I'll hand it over to Eve.
Okay. Well, thanks, Paul. You can take that off, I think. Yeah. And good morning, everybody, and thank you so much for joining us. I am really fortunate to be able to introduce Micheal Dunn of Williams. Micheal is the EVP and Chief Operating Officer of Williams. He took on that role in 2017. And I don't think there's any coincidence whatsoever that you've seen Williams being, top tier in terms of execution in the midstream space. And, Micheal, I'm not even sure if you get enough credit, but you take a lot of the credit goes to Micheal. Wells Fargo put out their Show Me the Money piece a couple of weeks ago, which showed that Williams, over the most recent 5-year period, had just about a 23% return on invested capital, 22.9 to be exact. And that was well above the industry average of 11.9% over that time frame. And I think if there's anything noteworthy about Williams over the last, at least 5 years, is the fact that they've done a terrific job of execution. So with that brief introduction, Micheal, take it away.
Well, you're very kind, and I appreciate those kind words. But I will tell you, it's the great team that we have here at Williams, and I've always been able to find people that are smarter than me that work with me and really carry the bulk of the accomplishments here. And not only having a great team, but having great assets certainly helps in the right place. And I'll talk more about that. Really appreciate the opportunity to tell you about the Williams story. We have, really a very narrowly focused natural gas strategy here at Williams, going on for more than a decade now. And really, we've had a really strong belief in the benefits that natural gas can provide, not only from an efficiency and economy standpoint, but for reducing emissions, not only in the United States, but worldwide. And we've got great examples of that in our investor materials that we talk about all the time, where we can use more natural gas at the same time reducing emissions. And there's been a dramatic emissions reduction in the United States. And in fact, we're below the Paris Climate Accords targets that were set from a 2005 level in the United States. And that's primarily because of natural gas and not because of solar and wind, although they've been great contributors. But the bulk of that, the majority of that, has come on the backs of natural gas replacing coal in the US. And we're doing the same thing worldwide with LNG that's leaving the shores of the US. And certainly Williams is doing our part to bring the pipelines to those LNG facilities and improve the emissions profile around the world. We've got a really strong asset in our transmission businesses, in the Transco business, but we also have the Mountain West and Northwest pipeline systems that are really key to the Intermountain West and the Pacific Northwest. And we're seeing a lot of great growth opportunities out there. People hear and talk about our Transco growth opportunities all the time, and those are phenomenal. But we can't forget about the singles and doubles that Northwest Pipeline and Mountain West are hitting out west, and really seeing a lot of activity picking up there as well. Our gathering and processing systems are very diversified across the U.S. We're really in every major basin in the United States, with the exception of the Bakken. We don't have a footprint in the Bakken, but everywhere else we have either assets that we're partners in with JV partners, or we're the operators in those basins, whether it be dry gas or associated gas. And really very proud of what our teams have been able to pull together since I've been here over the last 8 years. And we really had a great foundation here in the business from a growth standpoint, continuing to have an incredibly strong backed dividend and capital allocation policy that is really fared us well, as you heard Eve talk about in the beginning, with our really strong return on invested capital over the last 5 years. So, love to hear the questions that you have for me today, and we'll do our best to try to get those answered for you.
Okay, as I promised, right down the fairway. So the first question really is, what are the implications for Williams of the Republican sweep?
Well, I think they're really positive. I think we had a lot of things going our way in regard to demand for natural gas in the U.S. In regard to the data center load growth that we're seeing, power generation converting to natural gas from coal. That was not going to change the trajectory at all, no matter who was the president. And I'm even more encouraged by the fact that the House and Senate are both Republican now. And I think that will allow us an opportunity to do some work on taxation. I'm hopeful we'll get some bonus depreciation included in some tax reform that's coming our way. And that would help us on our cash taxes. We've talked about being a cash taxpayer for the first time this year on a modest basis. That's the first time since 2008 we've actually had to pay cash taxes, and that would be growing in 2025. But bonus depreciation would help where we can actually eliminate some of the cash taxes that we would be obligated to pay. On the permitting front, very encouraged by the fact that we've got a House and Senate that would be keen on correcting some of the permitting missteps that have been out there for not only us, but for electric transmission power lines that are trying to be built as well. It takes longer to permit power lines across state lines than it does pipelines, if you can believe that. And it's pretty difficult for us to permit pipelines these days. But I would say we're going to have some opportunity to get some of those roadblocks out of the way. We never are looking for an easy path. I mean, we're looking for a certain path when it comes to permitting. We don't expect it to be easy. We've got no problem with hard permits. But we want to know what the path is, and we'll adhere to the rules of the road. But there's been so many roadblocks, like the 401 water quality certifications, that some of the states have used to weaponize against us when we have a full NEPA evaluation done, a full environmental impact statement prepared by the FERC. And then a state comes in at the last minute, not participating in any of those processes, and decides that from some murky, no pun intended, permit process, they're able to kill, billions of dollars of projects, not just ours, but across the industry, with a 401 water quality certification process. And we hope to get that corrected, get that process embedded within the NEPA process and the EIS process so that it's not done outside. And then get a judicial reform so that we don't have continuing litigation against biological opinions and decisions from the FERC. And then, we get decisions made and then they just come back on another angle. So I'm very hopeful those things will get corrected. The Supreme Court's taken up a really interesting case on NEPA that unrelated to the pipeline industry, but it was a railroad issue, but it has a lot of implications that I think would have resolved whether, the Democrats or the Republicans won the presidency. And that was looking at upstream and downstream impacts of a decision outside of the purview of the permitting agency. So there's a lot of opposition that says on a FERC regulated project that the FERC should be looking at the upstream and downstream impacts of that natural gas moving through those FERC regulated pipelines. And FERC's always taken the position that's really not their place to do. They've had different chairmen that have been on both sides of that, and they've tried to walk that line tightly. But now I think we're going to have the FERC has taken up a case on the railroad where they had the exact same opposition. It was a railroad that was being built to transport crude, and advocates against the project were basically taking the position that the permitting agency should have been looking at the downstream impact of that crude issue. And I really think the Supreme Court's going to resolve that once and for all. Really interesting case in the DC Circuit this week in regard to the Council on Environmental Quality and what regulatory permitting processes that they have taken part in. And I mean, this one's kind of thrown everybody for a bit of a loop, but I think actually good for the industry, probably bad for the environmentalists and the opposition to pipelines, is that, the Council on Environmental Quality was supposed to be, making suggestions to regulatory agencies and actually not setting regulation. And many of the agencies have adopted the suggestions from the Council on Environmental Quality as regulation, and subject to the whim of a president when they come in and basically change that. And so really interesting case that's come out this week that we'll see how that unfolds ultimately. But I think it's certainly boding well for the industry to get some of those things corrected where, Congress should be making law and regulation, not either the agency or the Council on Environmental Quality. So really encouraged by a lot of the things I see there. And then finally on the FERC front, Chairman Phillips is a Democrat. He's been chairman of FERC now for a while and frankly done a really good job. I've been very pleased with him moving projects along, being tough but still fair and actually moving projects through the process. But as is typically whenever a new president comes in, they put their party's person in charge of the FERC. So one of the Republicans that's currently on the commission will likely become the new chair. And Chairman Phillips can stay on as a commissioner if he so chooses until his term is out. I'm not sure what he's going to do, but very likely we would see him replaced once Trump comes into office, and we'll have a new Republican in control of the decisions and permitting at the FERC. Go ahead, E.
I was going to just ask about the EPA, especially they had that one policy on carbon capture for power plants, coal and natural gas. How do you think that plays out?
Yeah, I'm sure that will get corrected or changed. I think even no matter who was going to be in charge of the presidency for the next 4 years, I think there were going to be some huge challenges with these new gas plants having to have carbon capture installed on them by date certain. I think it was 2030 or 2033, depending on the power plant. That's going to have to go by the wayside. There's really no way to be able to provide the power that this country is demanding with those kinds of regulations. Maybe they put some economic or technically feasible type language in there. I'm not sure what will happen there, but very likely that EPA power plan will be lobbed back over the fence again with many changes coming. So I think that's an absolute that has to happen. They're even talking about delaying the retirements of coal plants because of power demand. So if that's the case, then they're certainly going to have to correct this issue that would really make these gas plants fairly uneconomic for consumers.
Yeah, it seems to me, and I'm curious if you agree or disagree, that the Republican sweep probably is more beneficial for what I'll call the infrastructure players than necessarily, the upstream players. Do you have a thought
Yeah,
on that?
I would say so. I mean, there's not as much impact on the upstream from the federal side, with the exception of lease sales in the Gulf of Mexico. I think we'll get that corrected now. There's been some court cases that have, purported to stop the activities in the Gulf of Mexico. That's because of a challenge to a biological opinion. That's been delayed now, and I think that will obviously get corrected once a new biological opinion comes out. Not to say that there won't be, attacks from the environmentalists trying to stop lease sales, but I think from a federal standpoint, that's where the federal government has the most influence on the upstream side. Most of the oil and gas production that's occurring in the U.S. is on private lands today, for the most part, until you get way out west, in like Utah and Wyoming. So the federal government really has a pretty strong influence on the lease sales that would occur, and I think we're pretty encouraged by the fact that now we'll have a regular cadence of lease sales in the Gulf of Mexico, because we're incredibly bullish on the Gulf of Mexico. There's a lot of opportunity out there in the deep water. The 20,000 PSI facilities are starting to come online, Anchor with Chevron's projects come online. There are others that are looking to use that same technology that's been unlocked there. So a lot of great opportunity in the Gulf of Mexico, and I think now that the administration has changed, you'll see some lease sales and a lot of activity out there.
And you could be a major beneficiary of that.
Sure can, and I think we will be. We've got three distinct areas in the Gulf of Mexico between the Gulf East, the Gulf West, and then our discovery system in the middle, which we used to be partners with P66 on. We bought them out earlier this year, so we own 100% of that system now. And we're very, very excited about the Gulf of Mexico. We've had, an opportunity to grow the business there, more than doubling our EBITDA over the next several years here from where we have been in the past. primarily through projects that don't require a lot of capital or any capital on our part, with what we call tiebacks to existing platforms there. And the biggest project we have is the Whale project with Shell and Chevron over in the Gulf West side. We've completed all of our work there. It's been, probably 8 years in the making from when we first started negotiating this with those customers to today, and really excited to come online, hopefully within the next month or so there with them.
So, Michael, can we pivot what your views are on the macro? It's really fascinating. I've been doing this a while. I remember low gas prices, the pipeline stocks would get crushed. That's not the case today. You have low gas prices, and your stock has done well, and midstream stocks have done well, and you're the pure play natural gas stock. So maybe you could describe the macro environment and perhaps describe why have you done so well with low gas prices?
Well, I would say the exposure that we have to either low or high gas prices is pretty muted, because the fact that demand is so high. And that's, I've heard Alan talk about this so many times, Alan Armstrong, our CEO, where we really focus on demand. What is the demand for natural gas and the natural gas products? And because of the fact that we've had huge growth in the LNG facilities, we're delivering, about the whole industry is delivering, 12 to 13 BCF a day to the LNG facilities. That's like 8 to 10% of all of our production that we have in the U.S. today. So huge growth there. We had some days this summer where 50 BCF a day of gas was being used for power generation. I mean, that was unheard of 10 years ago. And so a huge appetite in this country as well as worldwide for natural gas. And I think that's why we're so confident about the fact that either low prices, we're obviously a lot more concerned about high prices than low prices, because high prices will force somebody to find an alternative to natural gas. Low prices encourages demand. And so for us, low prices, we think about it in the opposite effect, that it really spurs demand. And you see, that in the story for natural gas demand for the last several years here in the U.S. So we want prices to be high enough for our producers on the upstream side to be healthy, and they all really are healthy now from where they were several years ago. They all got their balance sheets in great shape, and really being disciplined when it comes to their capital deployment in the upstream. And there is a significant amount of natural gas resource in the ground still in the U.S. And I think that's the other thing that really encourages us, is that there are decades and decades of natural gas that is technically recoverable and economic, well beyond the timeline that anybody ever thought, just because these producers continue to find ways to unlock more resource and are getting more and more efficient with their drilling. I mean, they're drilling 3-mile laterals underground now. They go down 10, 12,000 feet and go 3 miles out horizontally into these formations. And it's just incredible, the technology that they've deployed there. And they can keep that drill bit within about a 3 to 5 foot window in that rock. And they know exactly where it is, and they steer it exactly where they want to go. And that has made them much more efficient with a lot lower rig count than they've had in the past.
So what are your views on the supply demand dynamics for natural gas? And do you have I guess it'll be a three-part question. That's one, but two, do you have an opinion on natural gas prices? And three, and I think you mentioned it, what does Williams have much sensitivity to high or low natural gas price, especially because you still have, some small E&P assets and you do a little gathering, well, a lot of gathering and some processing.
Right. Yeah, I would say, we're pretty blessed in regard to the exposure there, because we're exposed to dry gas plays, we're exposed to rich gas in the Northeast, and we have some exposure in the Permian to the associated gas through JV that we have with the Brazos entity, as well as some of our own gathering out there. So we have a lot of diversity when it comes to the gathering systems exposure that we have there. Sometimes the dry gas is more valuable to the producer. Sometimes the rich gas is. And, we've benefited from that. Even in a year like this year, whenever production has been down dramatically, I talked about on our earnings call, last week. There's 4 BCF of gas shut in or not producing today that could be just on our systems between the Northeast and the Haynesville, where producers have shut in the gas, or they've drilled and completed a well, or they've drilled a well and they're waiting to complete a well. And, that gas can come on very quickly. So we feel really good about that. We feel really good about the fact that we posted really strong numbers this year in spite of where the gas prices have been, just because demand has stayed up. But we anticipate some of this shut in production every year in the shoulder months, and so we embedded that within our business plans. I would say the greatest growth story that we're going to have coming out over the next decade or so is LNG. First of all, we expect LNG to double from where it is today, leaving the U.S. There's a lot of projects that are either under construction or awaiting FID. There was obviously this pause on LNG permits that the Biden administration put in place. That will be going away, I'm assuming, on January 21st or 22nd, if not before. And, they'll be back to the races in regard to commercializing their projects. I talked earlier about data center demand, and, we expect data center demand to more than double. It's 22,000 megawatts in 2023, and we expect that to probably be around 45,000 megawatts by 2030. And that would equate to maybe about 4 BCF of incremental gas demand if all of that is met by natural gas. And right now, that's what we expect to happen. Our Southeast Supply Enhancement Project on Transco is a 1.6 BCF a day expansion. Now, that's primarily driven by power generation load growth, and a lot of that driven by data center demand in the Mid-Atlantic and Southeast. So we're pretty bullish on power generation from natural gas. We're talking to actually a lot of data center developers about building pipelines for them, supplying the gas through our Sequent marketing company, and possibly even building the power generation for them with simple cycle turbines, because they can't wait on the electric companies to hook them up. It's just too long of a delay, and time is money for the data centers, the hyperscalers, or the folks like Amazon's and Microsoft's and Google. They're out there building all of these data centers as we speak, and they certainly want reliable electric supply. In the past, many of them talked about having electricity that was from renewable resources, solar and wind, possibly batteries. Today, they're talking about, I don't care what color my electrons are, I just need power, and I need it fast. And so they're even talking to us about building potentially power plants for them behind the meter until they can either get connected to the grid or get an alternative resource from solar or wind with, what we would expect a very quick payback on that investment. So a lot of great opportunities that we see there on the demand side. Having talked about coal to gas conversions, we're seeing a lot of that out in the Western U.S. We're capturing very much the bulk of that market, whether it be Utah, Wyoming, right now between our Mountain West and Northwest pipeline systems. A great opportunity to continue to do that. That's probably the largest concentration of coal in the West, obviously in Utah and Wyoming, but even in the U.S. And if you think about the Transco corridor, there are about 70 coal plants within the Transco corridor that we could serve if they converted those boilers to natural gas or built new natural gas combined cycle power plants at the same footprint site. That's close to 10 BCF of new gas demand if it were all converted to natural gas. Now, solar and offshore wind will continue to penetrate that market, especially on the East Coast with offshore wind. But even a lot of those offshore wind projects we're seeing, a lot of those have been canceled because they can't bill for the prices they committed to when they bid into those RFPs. And so offshore wind's pretty challenged from a cost standpoint and a price standpoint to consumers ultimately.
So, I mean, do you think folks are getting a little bit overly optimistic regarding, the demand? And well, that's part of the question. And the second is, if they're getting overly optimistic, what are the governors or the obstacles that might, disrupt that kind of trajectory. And can we just go back also, and I apologize, but when you talk about the data centers, are you talking mostly along the Transco corridor, or are you also, where are you talking,
It's
geographically?
Yeah, it's all across our footprint, actually, not just Transco. And in fact, we've got the Nortex storage facility that we bought in Texas. We've got 1,000 acres of land there associated with that. It's west of Dallas Fort Worth area, 40 miles or so. Great location for a data center. So we're offering that up to people that say, we've got a lot of land here we can offer you. We have gas storage right on site, and there are power plants in close proximity to that. So it's anywhere that we have a footprint. That's what we're talking to people about. We have a lot of land associated with our facilities, and we talk to people about co-locating on that land right next to our compressor facilities or our processing plants or our storage facilities.
So are we getting over our skis in terms of, the growth expectations?
I suspect there is some bubble in regard to double counting here of some of this demand growth, but it has been happening. It's just people weren't talking about it nearly as much as they are today. But I do think that there was going to be opportunity with and without data centers. Coal plant conversions, that ship has sailed. Those coal plants are going to convert. They are not economic to do any more controls on these coal plants. The coal ash problems that most of the utilities have are not going away. And in fact, they've got to go rectify those issues. So obviously they don't want to create any more coal ash than they possibly need to. So I don't see anything changing in that trajectory. Duke just got 9,000 megawatts approved in their IRP for gas plants to be built. And obviously the Southeast Supply Enhancement Project is a large portion of that load, but I don't see that trajectory changing. So coal plants are going to convert to natural gas, and I suspect more natural gas. People are waking up to the reality that solar and wind are intermittent and not dependable. And you only have one other choice, because batteries certainly can't fill that void for very long. I mean, the batteries today, you might have 2 to 4 hours of capability from a battery backup. That's not going to help you in a Winter Storm Elliott or Winter Storm Uri type event. And you really need to ensure that you have natural gas. You need to have firm transportation for that natural gas. A lot of power generation is not backed by firm transportation on the pipeline systems. They rely upon interruptible transportation. They don't have storage. That bodes incredibly well for our business, because PJMs, the MISOs of the world, have a responsibility to ensure that there's reliable power generation there. And I think that reality is coming home.
Yeah, actually, you mentioned Alan Armstrong, CEO, and he's made the point, and I think a really strong point, that that it's really the capacity that you're selling on the pipelines and not necessarily the volume that goes through the pipelines. And you might want to just perhaps comment on that.
Right. If you think about, we've got the Transco pipeline system. It's a 20 BCF a day pipeline system. And we earn virtually the same amount of money on that pipeline every day, whether there's any gas flowing through it or not. There's a very, very small commodity charge, but most of it is a take or pay charge. Obviously, we want the pipes to be full, but we're getting paid no matter how much volume moves through that pipe. And that's the same with all of our other pipeline systems that are FERC regulated. There are take or pay pipelines, long-term contracts. When any capacity becomes available, it's snapped up instantly by the market. And virtually nobody releases Transco capacity anymore because it's so valuable. So yes, we do focus on throughput on our gathering systems, and that's why we focus on demand, obviously, because demand for natural gas does drive business through our gathering systems. But the fact that we transport through our systems about 1/3 of all the natural gas in the country, we do focus on throughput because it's important for our gathering systems. But 45% of our earnings come from our regulated transmission business, so it's a fairly well locked in result. And if you look at the historical results of the volumes going through our pipeline systems, they've been very, very predictable on the gathering side as well. And that's certainly helped by the fact that we're connected to some of the best basins in the country, and that demand for natural gas has been so high. I'd say the real story that we've been talking about lately is storage, natural gas storage, and the fact that there's been virtually no new storage built over the last 20 years or so in the U.S. We're seeing a lot more demand for storage. We saw this many years ago when we developed our strategy session for our board, and we went to the board and said, we really think storage is going to become more valuable. We were learning a lot of this intelligence through the Sequent company that is our natural gas marketing company that we bought from Southern Company about 3.5 years or so ago, and knew that, I mean, they're in most of the storage facilities in the U.S., and they saw the fact that there hadn't been any built. And when they were renegotiating storage contracts, the rates were starting to creep up. And it was primarily driven by the LNG players needing storage, needing a place to go with gas whenever they had an incident or, a shut in for maintenance on their LNG facilities. And so we saw that, and that's when we acquired Nortex. We acquired Gulf Coast Storage earlier this year from Hartree, and we have about 450 BCF of storage today. And the great news is when we are recontracting those storage contracts, we're seeing the rates and terms go up pretty significantly and well in excess of our acquisition economics. So very happy with our storage position, but we think more storage needs to be built. And that gives us a great toehold into that to build some brownfield storage at our existing facilities that we now own.
Can you talk about the dynamics in Haynesville as well as Appalachia, especially given all this perhaps pent-up demand for natural gas, but you have low natural gas prices? What are you seeing out there? And, what kind of natural gas price do you need in order to satisfy the demand and get the production?
Well, I think a lot of the producers, their break evens continue to come down because of the efficiencies they're generating. You see, the consolidations that are occurring in the space. I think that's helping the economics as well. Assuming they're not overpaying, and I don't think they are. There's been some really great consolidation efforts that have occurred there. Chesapeake and Southwestern creating Expand Energy is one great example where they're a large customer of ours. And I would say they're anxiously awaiting the LNG facilities to come on from the Haynesville standpoint. You see more and more projects now being announced that are kind of moving gas from the Haynesville area to what we call Station 85, which is in the southeast. It's the Mississippi, Alabama area. It's a very liquid trading point for natural gas on the Transco system. And that bodes well for Williams, because then we can build projects northward from Station 85 once those projects get commercialized. And I think that will ultimately generate business for us. But as you see more and more natural gas coming from the Permian associated gas play, you see that pushing eastward toward the LNG facilities. That pushes Haynesville gas south and east as well. So all of that is pushing business our way, if you think about it. Transco is connected to virtually all of the LNG facilities that are existing, as well as being proposed either directly or indirectly. And so that just creates more and more opportunity for Transco to expand. I think producers are really sitting pretty well right now in regard to their break-even prices. You'll see them shut in gas. If gas gets to a point where it's not economic for them to continue to produce and they want to bank that gas, just like we did this year, you'll see them drill wells and not complete them because the completion is actually more expensive than drilling the wells. And so they'll hold off completing a well, which is a pretty quick process ultimately. So they can respond very quickly to a price signal, lock in via hedging, some of that, and then start producing the gas. So I think you're going to see this gas price stay pretty range bound for the foreseeable future until some of these big LNG facilities come on. And what really needs to happen is more pipelines need to be built out of Appalachia, for example. There is a tremendous amount of natural gas in Appalachia still. Transco is going to be a big beneficiary of those projects being built out of Appalachia. And as I talked about earlier, I think permitting reform is really going to help us get more projects built out of that area. Many of the projects have been stopped. Atlantic Coast Pipeline was stopped We had our Constitution pipeline, we had our Northeast Supply Enhancement pipeline, Penn East got stopped, all because of these permitting issues that we're all talking about here. So I think we're going to be able to unlock a lot of that. I think you'll have a Mountain Valley pipeline expansion most likely. They've been talking about since EQT bought them, that would bring more gas to Transco, and that's going to give us the opportunity to continue to expand Transco north and south from Station 165 in Virginia, where they connect with us.
Do you think we'll ever see a greenfield pipeline built on the East Coast?
Well, that's a great question. At some point there may be one that's needed. I think some of these states, will wake up and realize that natural gas isn't the demon that everybody's made it out to be, and that they really do need natural gas in their state to attract new business, to attract industry. And I think we're ultimately going to be successful in that. There may be an LNG facility built on the East Coast somewhere someday. There's been talk of that for a long time now. That's the quickest route to Europe from Appalachia. If you can get an LNG facility like Berkshire Hathaway's Cove Point, Dominion used to own that. Kind of keep straight on all that. But Cove Point's in a great position to serve Europe, for example. You could have another LNG facility built on the East Coast. The sail times are dramatically lower from the East Coast. That's a big proposition, though. Those are $10 billion facilities, and then the pipeline that has to be built to it is another multi-billion-dollar endeavor. So it's not without risk and challenge. And the fact that it takes so many years to permit and build those, you have to be really careful with entering into something like that with a change in administration that could maybe put all that to rest. Unfortunately, if a new administration comes in 4 years from now and it's not supportive of the industry, then you could have another permitting pause, for example, or a construction pause. So it is difficult to get those things commercialized because they take so long to permit and then years to build.
Right. But it sounds like, from the start of the conversation, you unless I misheard you, you think that Congress will create legislation, for permitting. And so if you do have a different administration 4 years from now, it may very well take a congressional act to reverse the permitting.
That's right. Yeah, we should make it so it's difficult to unwind at the whim of an executive order, frankly. We can't continue to have executive orders, being our regulations.
I don't know who said
no matter who's president.
Yeah, who said the pen is mightier than the sword?
That was a previous administration, but they've all done it. Every president has used executive orders, and that frustrates me because I don't think that was the intent under the Constitution, frankly.
Well, what do you attribute to the high returns that Williams has been able to do year in and year out, and can that continue? Can it even get better going forward?
Well, first of all, I would attribute it to discipline. We've been an incredibly disciplined organization when it comes to capital allocation. We've picked very good projects to go and build. They are we're in areas that are growing significantly. Even if you look at a map of the Transco system, it goes from the Gulf Coast to New York City, and it hits every major population center along the way. Where you're seeing the Carolinas are growing significantly. You're seeing Georgia growing significantly and requiring a lot more demand. And that's given us a lot of leverage when it comes to negotiated rate projects on our FERC regulated projects, such that we're getting very high returns on those projects, well above our recourse rate. And if you think about the return we get for maintenance capital on our FERC regulated projects, that's a low teens return. That's utility-like, a little bit better than utility-like returns. But we've been able to get much, much higher than that on our negotiated projects. And by a negotiated project, I mean, Williams, we come in and we say, we're willing to take the risk on the cost. So we're going to guarantee you a rate, no matter what the project costs, and it will be for 15 or 20 years. We will take the permitting risk. for that project with certain outs. We'll have an out if, we don't get certain aspects of the permits, but typically we're taking all that risk, and we've been able to negotiate those. We've been able to bring those projects in under budget, actually, so that helps our returns because we don't have to change that rate that we agreed to with that customer. And so virtually all of our projects over the last 6-7 years have been coming in under budget, the negotiated rates. Juices our returns even more. And I don't see that. And in fact, it's actually getting better. I mean, if you think about the Southeast Supply Enhancement Project, it's probably one of the best returning projects we've had since I've been here, especially for the investment. It's a $1.5 billion capital investment with a very high return. And, we're able now to negotiate. We have so much leverage. We're able now to negotiate with customers that they will actually reimburse us for our permitting costs if we're not able to achieve permitting success. So it's definitely moved in our favor in regard to taking some of that risk off the table for those projects. So I would say a great story there on our regulated return projects. Moving to the Gulf of Mexico, those are infinite return projects in the Gulf of Mexico because we're spending zero capital. The producers are spending all the capital on their side. They're building the pipelines to the existing floating production facilities that are already out there, moving products through our existing infrastructure that's been there for 10 or 20 years and already bought and paid for. And so really, really obviously helping to get us that 21% return on invested capital, because that does factor into that equation. So I don't see that changing in the Gulf of Mexico either. The producers are still looking for areas that they can tie back to existing infrastructure that's already there and not having to commit to build a new floating production facility if they don't need to. They go out and drill incremental wells, bring that to us. So I don't see this changing for us at all. We're in a great position. We're going to be incredibly disciplined when it comes to our capital allocation. Our balance sheet's continuing to get better and better. That's one thing the board said when I first arrived here, is that one of our first priorities is improve our balance sheet. And we've been able to do that and continuing to expand our capacity because of our earnings growth. And it's just a great story that we have there. And, I think that will be nothing but continuing for us.
Well, how do you go about sanctioning new projects? I mean, does the hurdle have to be above 20% because you have such a high return on invested capital?
Well, if you think about it, it depends. Our emissions reduction program, for example, on Transco, that's a regulated rate of return. So that'll be obviously determined from our ongoing rate case that we have at Transco. But, we file for something in the 13-14% return on equity range for something like that. We'll get something probably lower than that at the ultimate outcome of our rate case. And so that's probably the floor that we're looking at for any investment in the business, whether it be our new energy ventures, anything like that. And then you think about, okay, what's the highest return? Well, it's a tieback in the Gulf of Mexico that has zero capital. And so you have to think about, okay, is this a defensive in nature investment we're making, in a gathering system so that, we don't lose some dedication, we don't lose, an area that we could bolt on at some point in time. And it all depends on what the investment is. But the whole balance, we would love to keep it at a 20-21% overall return on invested capital. And that could actually go higher depending on how many of these Transco projects we continue to capture.
So how do you think about you have over $10 billion of, I guess it's potential, projects. I'm not sure if what kind of conversion rate you'll get on that 10 billion, but right now you're spending, somewhere between 1.5 to 2 billion. What kind of cadence do you think you'll see year in and year out for however long your vision is?
Well, if we stayed at the 1.5 to $2 billion per year in regard to our growth capital, you start thinking about, okay, what's our balance sheet doing at the same time? So if we stayed at that level, our debt to EBITDA ratio would continue to go down. that's naturally going to decline because of the earnings growth that we're continuing to see. And so you think about, what do we do with that balance sheet capacity? Do we continue to drive our investment grade credit ratings higher? That's one option. Do we do stock buybacks? Do we do a dividend policy increase? We've committed to increase our dividend right along with our AFFO cash flow trajectory. And so there's an opportunity to continue to expand that if we choose to do that. I mean, it's what's the best return for our shareholders in regard to that balance sheet capacity that we have. And so that's the decision that we make, obviously ongoing with the board. We could expand our growth capital if we choose to do that. If the board thinks that's the best deployment of our capital, then and the opportunities are there, I would advocate for us continuing to grow the business in regard to that. So I feel very confident about our backlog of projects. You refer to the $10 billion. If you think about how many projects, our backlog has kind of stayed static, the amount of projects in the backlog, but that means we've moved 12 or 13 projects out of that backlog into commercialized execution. We've backfilled that with 10 or 12 other projects. But I can tell you, our team is working on hundreds of projects. And, the ones that we actually put into the backlog are the ones that we feel very confident that will ultimately commercialize. So we've seen a complete ramp up in the amount of work our project development teams are doing. And in fact, we're having to deploy additional headcount and resources to that area of the business, and including our commercial teams, because there are so many opportunities they're evaluating out there. So I'm incredibly bullish on what the future looks like for the opportunities that we're exploring.
Well, you folks are targeting a 5 to 7% type of growth rate, and you've exceeded that.
We have.
So are you just sandbagging us, or could you see that growth rate accelerate?
Well, we like to be confident in what we tell investors. We want to be certain that if we say 5 to 7, we're going to be 5 to 7. Now, we've been 8% for the last several years when we've looked at that on a growth rate basis. And so, but if you think about on an individual year, you might be 4 one year, you might be 6 the next. And so it all averages out over a longer term to be 5 to 7, maybe a little bit higher than 5 to 7. But, we have a pretty darn good line of sight to the projects, 3 years out, because you're already permitting those, you're already planning for construction. Then you get 5 years out, it gets a little bit less clear. So you get 7 to 10 years out, it's even less clear. And so I think that's why you'll look at us saying 5 to 7 for, the next 3 to 5 years, because we have a lot of great certainty to what that next 3 years for sure looks like. And then, beyond that, it's what's in the backlog and what are we negotiating. And we're negotiating projects today that are 2029 in service dates.
Wow.
So we're having a pretty good idea of what's out there, but I don't ever want to, come back to an investor and say, sorry, we didn't hit our 5 to 7. If we say 5 to 7, we're going to be very confident we can hit 5 to 7.
Okay, so I apologize up front for this question. But is it fair to say, when you go, your outlook today versus what your outlook was 5 years ago, do you think it's similar or better?
Oh, it's better.
Okay.
I mean, I feel good about where we were 5 years ago, frankly, but I'm even more optimistic in regard to, for a number of things. The load growth that we're going to see in the U.S., I think, is going to be very significant. I think manufacturing is going to continue to come back to the U.S. I think people are going to want to, build here, and I think that bodes well for us. I think LNG is going to continue to grow. I didn't even talk about our next gen gas product, but we're able to show what the emissions profile all the way from the wellhead to the burner tip for a customer, and we're actually able to sell that through our Sequent marketing organization. We have a natural gas marketing company that's top 5 in the U.S. They are very, very big player. And I say that because not because of the earnings they create, which are wonderful for us, but it's the information and the data gathering that they get for us for the rest of the organization to make decisions on that is incredibly valuable. And I think that's the thing 5 years ago we didn't have. And so that creates a lot more optimism for me that we actually have a lot more market intelligence and knowledge than we had 5 years ago.
This wasn't on the list, but I'm just curious. Yeah, how do you think about AI in terms of how you can deploy it? And what triggered that is, they must have tons of data that can help you.
Yeah.
Any
We're already doing
Yeah.
some of that. I mean, it's certainly in its infancy here. And typically the pipeline industry hasn't been known as, being on the cutting edge of technology typically. And I think that's one area where we have a lot of opportunity. You have it in safety, for example, with our pipeline controllers and giving them instantaneous knowledge about something that's happening on the pipelines. And you can use AI to be able to detect small anomalies in the pipelines that a human couldn't detect in the past, or it might take 5 to 10 minutes for something to actually show up as an anomaly in a pressure that you can use AI to instantly find.
Yeah.
Or the computer knows that it's a power plant kicked on, and that's what caused the pressure to draw down. So I think just from a safety standpoint alone, I think there's going to be a lot of technology adoption there from an AI standpoint. But we're already using it in regard to evaluating like firm service sales or short-term firm or interruptible transportation sales and looking for market dislocations using computer technology that Microsoft helped us develop and has really increased our short-term firm and interruptible and parking loan revenues on the Transco system, especially. Because years ago, Northwest Pipeline was actually earning more revenue on short-term firm parking loan sales than Transco. And I went to the Transco team and I say, okay, your brother over here is beating you,
Yeah.
and there's no reason for that because you're a much bigger system. So let's find out the value that we're leaving on the table here. And they've done that and done a tremendous job improving that.
Yeah, I want to be mindful of your time, and I apologize because it's run over 45 minutes, but I just have a couple more if I could.
Sure thing.
I was a little surprised, which is not a surprise that I was surprised, but I was a little surprised that your opening remarks were around emissions reduction, and so the question is, can you talk about that? In terms of what your targets are, and as it relates to the new administration, uh, do you think that there'll be less focus on emissions reduction going forward? Or has the train left the station and all and the companies that have emission goals are going to live by them and continue to make progress?
Yeah, that's a great question. I think it's important for us as an industry and certainly as Williams to do our part to protect the environment. That's kind of the license to operate for us. We have to do our part to reduce emissions. The pendulum swings back and forth depending upon the administration, and I'd like it to not swing as far. I'd like to have a lot more certainty there, but we still, as an organization, will do our part to reduce emissions. And first of all, it's good business for us because it's an investment opportunity. You think about our emissions reduction program on Transco. We'll have replaced 112 units between Transco and Northwest Pipeline by the end of this year. And by units, I'm talking about the big reciprocating engines that were installed in the 1950s. We'll have 112 of those replaced with new state-of-the-art gas turbines and electric-driven compression. And I've got a great example of how this benefits a state. In the state of Virginia, we replaced 2 of our stations on Transco, took out about 25 units in those two facilities, put in electric and also gas-fired turbines. We reduced the stationary source NOx emissions in the state of Virginia by 10%.
In the state? Wow.
In the entire state, not our emissions reduction, the entire state stationary source NOx emissions in Virginia were reduced by 10% by us replacing those 2 stations That's a great outcome for the state because obviously NOx is a precursor to ozone. Ozone is a human health hazard. So we've done an incredible job of reducing emissions there in an area that's a non-attainment for ozone.
Hmm.
And that helps the state. That helps the state thrive. It helps the state, talk about what they're doing to protect the environment, and we're doing our part to do that. And I don't know if the environmentalists will ever acknowledge, accomplishments like that, but they can't criticize us for not doing our part because we
Right.
are, in my opinion.
Well, that's great. Just two quick ones. Any
Sure.
thoughts on M&A? And you've made small acquisitions from time to time. Yeah, how do you think about it?
Just once again, be disciplined. And, you've heard our team talk about this all the time. We look at everything that's out there and transact on very little. And bolt-ons have been very successful for us. And that's one of the areas where we've been able to accomplish, some of this great performance for the business by bolting on either something that's, adjacent to our system or within our system that another operator owned, and then taking the cost out of that. Tremendous cost savings for us to be able to do that. In many respects, we don't have to add any overhead or headcount to be able to do that. And we take all of their overhead out of the business that they had. And so we've been able to acquire things at very good prices. If you think about the Mountain West acquisition, Berkshire Hathaway was willing to pay about $1.7 billion for that. Southwest Gas paid close to $2 billion for that. We paid under 1.5 billion, including debt, for that. So we made it a heck of a buy on that, and it's performing well in excess of our expectations in our acquisition model because of the growth opportunities that we didn't give any credit to, frankly. And now we're able to commercialize those. So we'll continue to find opportunities like that, and we'll be incredibly disciplined when it comes to M&A.
And I promise my very last question,
Right.
which is my favorite question. What should we have discussed that we haven't discussed?
We didn't talk about the rate case on Transco.
Okay.
That usually gets a lot of headlines in regard to what's happening there, but it's pretty quiet right now. We made our filing in August. We had an obligation from our previous settlement in 2018 to come back with a rate case by the end of August this year, and we did do that. And so we've made our filing. Pretty substantial increase that we requested, nearly 50% increase in rates. A lot of that driven by the investments we've made. But we've actually lowered our costs from where they were back in 2018 across the business. So our O&M costs are lower than they were in 2018, which is good for customers. We'll obviously give them the benefit of that. That was included in our filings. And then we'll be in the negotiation phase next year. So FERC will come out with their first position on our filing, which will be a low ball, as it always is, and then we'll bring those somewhere in the middle through a negotiated settlement through the course of next year.
That's great. Michael, I sincerely, appreciate all your time and patience in answering the questions. And I also sincerely mean that, execution, you have a large part of that. And I know it makes Steve Bergstrom really, really happy. So
yeah, I'd like to keep Steve happy. He's our chairman.
Yeah. So thanks so much. And
I appreciate your interest in Williams. Thank you for your time.
All right. You take care. Happy Thanksgiving too.
All right. Same to you.
Bye now.
Thanks.